Good evening and welcome to tonight's webinar, member-only content, ASX Investments Opportunities in Review for the 1st of March. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. Investor Signals provides a broking account service which incorporates access to our model portfolios, ASX and US high conviction. We now also run a global short strategy. We also offer an independent portfolio where we work in partnership with you to execute ideas that we jointly agree on across both ASX and US equities, and we have access to derivatives to enhance portfolio returns. If you'd like to know more about the broking account service, please contact me on 1300 614 002. The technology we're using tonight is the Investor Signals member area. We may have people joining us as part of their 30-day free trial. If you'd like to receive further tuition on how to navigate your way around the technology and utilise the main features, don't hesitate to contact the office. The graph up on screen there is of the Nasdaq. We'll move straight into a close-up of the Nasdaq and have a look at what sort of the main focus really is on this argument between are growth stocks overvalued and due for a correction. And we've seen obviously some pressure in high PE stocks as a result of rising interest rates, and that'll be part of the focus tonight, is to identify where we think there's opportunities and where you want to avoid risks due to excessive premium PE valuations in the market. So the Nasdaq up on screen here, we've had the correction from the highs of the last sort of 5 to 10 days of trading, which has been predominantly driven by the 10-year bond yields or yields globally pushing higher, but in particular if you look at the benchmark as the US 10 years, they've gone from 0.6% up to 1.6. They've settled back down a little bit in Friday's session, but we do have a correction in the Nasdaq from roughly 1,000 points, so from 14,150 down to where we closed on Friday night, which is around 13,200. The Nasdaq is stronger at the moment in pre-market trading, which is consistent with the reversal we saw in the ASX today. We're seeing Asian markets and European markets higher. Whether the index can rally back up and take out the prior high will really be a matter of where these interest rates settle. If interest rates continue to subside or move lower, then it is possible that the market could rally back up and create new highs. But there is a valuation argument that's pushing against that, where some of these stocks, as I've been talking about for a number of weeks or months, which are trading up at 50, 60, 70, 80, 100 odd times earnings or a multiple of revenue and are not profitable. So to give you an example, let's take Afterpay, one of Australia's leading investment banks or part of a global investment bank chain, but they have a price target on Afterpay of around $30 to $40 price range, opposed to its $120 odd share price. So there's the divergence between perception or what's perceived as value in the market versus momentum-based investors that are willing to just continue to buy the momentum as long as it continues to make a higher high and higher low and participate in the trade. There's a point where too many stocks get caught up with that, and that's the risk for the market. So as we move through the top 100, what we're trying to do is just recognize where there's reasonable risk return opportunities in the market and highlight where there's pockets of overvaluation. So just to finish on the Nasdaq, so we've had the sell-off, we've had a small rally back. We're likely to maybe get a test of this 10-day moving average. I think that's a good reference point. We've seen in other sell-offs where the market, once it breaks below that average, can sit below it for a substantial amount of time. Likewise on the way back up, if we have a look through this rally, there's only spent a couple of days below the average. We've had sort of a consolidation period in September, October, another leg to the rally, and throughout this stage, interest rates predominantly stayed below that sort of 1% mark. And then we started to see the 10 years push higher, and then there's ultimately been that breaking point really when they've traded above 1.2%. So we just watch the Nasdaq closely and just see whether it runs in a resistance at around this average, or whether it runs in a resistance below that prior high, or are we in the formation of another leg higher. I tend to sort of be a bit cautious, given obviously the Nasdaq contains some of the most overvalued stocks in the market. Let's start with moving into the ASX 100. I'll toggle through these and just provide some brief commentary around the stocks that we like at the moment. So we get the greatest percentage gainers to the top, we come over to the right, get the buys to the top. We're going to move through these to a point that we cover all the stocks under buy signals, then we're going to get to the switch where it goes from buy signals into sell, and I'll just draw your attention to that. So from the basket of stocks that are under buy conditions, we continue to like TPG, although there wasn't too much inspiring in the current earnings release. And predominantly the earnings were flat, and guidance suggests that we may see 5% earnings growth over the next 12 months. So TPG has the potential to pay out about 3.5% in dividends, and we look for sort of further clarity on that dividend policy as a driver there for TPG. Charter Hall, my preference, as you know, is to look at the property ETFs. So you may want to make a note of the property ETF, which is SLF, and we'll have a look at that at the end of tonight's webinar. But Charter Hall now under algorithm buy signals, as we're starting to see a number of these property stocks. So is Stocklands, which had a good day today, support there at around that $4 level. Atlas, so we're starting to see buying interest pick up there, and we've obviously got the switch to algorithm buy conditions that have occurred around that 550 level. Afterpay, so here's an example of where we've had say from $160 down to a low of about $110 as a correction, as part of that sort of readjustment of high PE valuations. But as I said, it's interesting that you have a large investment bank that had a price target of around this level here, around $38, and where the share price is sitting at the moment. But if we look back at the algorithm, we know from prior recordings that it did a good job of picking up the higher-low formations and the buying opportunity there, and for the moment it stays under buy conditions. Goodman Group, so this is a stock that I'm pretty comfortable with from a risk point of view. So the company's highlighted that they're growing earnings over 10%. They've doubled their development pipeline, and within the REIT sector, yes, you're only getting a 2% interest rate, which obviously means that the stock is at risk if interest rates suddenly spike, but it is a high growth business in the e-commerce space, obviously developing property trusts for e-commerce fulfillment centres. But around this 1650, I think that's a buy, and comfortable that there's an argument that deserves to be added back into portfolios if it's not already in there. Seek, I think, is expensive, but it was interesting. Sort of one of the stories here with Seek is that the founder is looking at spinning off, or at least separating, its investment company, which focuses on investments within technology and job placement type markets. But they're looking to separate that out and seed further investments within that tech space, and introduce third parties to participate in those investment opportunities, which will help reduce the capital requirements of the overall Seek business in that investment division, and may allow the company to pay a higher stream of dividends to shareholders from the traditional business. Now, that's the positive. The negative is Seek trades on a very high PE, and there is substantial earnings growth there. the risk with these high PE stocks is we really just don't know if there's another leg down to this correction. Do bond yields continue to move a little bit higher, and do we get another leg down in the in this growth trade? And we've seen Warren Buffett warn about the pockets of overvaluation in these growth themes. But that aside, we look at Seek in a continuation of risk off. We could see it down around $23, but for the moment we see support at 25, and it's shifted back to algorithm buy conditions there. Mervac under algorithm buy conditions, support around that $2.20. Xero, out of all the high PE stocks, I think Xero looks the most attractive as far as business growth and retained subscriber revenue. So support there at around that 110, and that is one of the growth stocks that we've added back into portfolios. BlueScope Steel under algorithm buy conditions, so it switched from sell back to buy, support there at around 1550. Delivered fabulous earnings results. CBA now under algorithm buy conditions, so one of the first of the major four banks to switch from sell back to buy. So we've added this into our top 20 model. Aurora switched from sell conditions to buy conditions there at around 240, continues to perform well. As I've highlighted in last week's recording, Aurora's conducting a share buyback which underpins some of the downside risk. Wesfarmers, although it hasn't had a further algorithm buy signal on this $48 low, and obviously switched from sell conditions to buy conditions back here at 43. We've added it into portfolios on this sell-off where clients are not already holding it, but certainly maintains a holding in our top 20 and top 50 model portfolios. CSL, so we like this off this 270 support. The first half earnings result was fabulous, as I've spoken about on the blog. The company has a low growth rate in the second half, and we're looking to see management of the company maybe upgrade full year earnings as they get more clarity around the second half trading figures of the business. JB Hi-Fi now under algorithm buy signals there at 44. The last signal prior to that was somewhere sort of through this light around $28-30. The stock's obviously well higher from that. Altium Group under algorithm buy conditions, one of these tech stocks that have broken lower, but I've put in the support there at around $25, and you probably just want to be patient and wait for it to trade above either the 10-day average or see evidence of this stochastic starting to move higher, but not doing too much there. Cochlear is in our model portfolio, switched from sell conditions to buy conditions there at around 180, and now trading 216, delivered a terrific earnings result. ResMed could be an opportunity worth adding to your list. We've seen this correct from 30 down to 25. Does trade on a high PE, but the recent trends within the earnings result have been tremendous. The company's delivering double-digit revenue and profit growth, so support there at around 25, thinking that it maybe bounces off that and trades a little bit higher. Car sales, we like this at around this $18-19 level, so as with Xero, it's one of our preferred sort of technology plays at the moment in the market, so comfortable with car sales. AusNet Services, support there at around 170. Woodside Petroleum, we like this. We recognise that Woodside's going to have to either divest some of its assets or maybe do a discounted equity raising to shore up its balance sheet. We've seen a little bit of pressure from the credit rating agencies on Woodside, but oil continues to move higher, and Woodside should be well supported off that $25 level, so comfortable owning that. GPT, again, preference just to buy the ETF SLF rather than take on too many individual property trust exposure. Cleanaway, I like this coming into tomorrow's dividend. Should deliver about 3 to 5% earnings growth at least over the next 12 months, but in a fairly safe sector with some reasonable growth prospects as they push into a more sort of vertically integrated recycling business. But support there at around that 220, and argue that that deserves to be in portfolios. Woolworths, One of the things worth considering here with Woolworths is you may have read in the paper about them spinning off their separate drinks division, which is called Endeavour Drinks. Um, so as a Woolworths shareholder, I'm not sure if that'll be a separate listed company or they'll look to do a trade sale. So you'll either end up with listed shares in Endeavour Drinks or you'll end up with a capital return. I'll continue to sort of read up on that and keep you posted via the blog. But Woolworths delivered double-digit earnings growth, slightly above that of Coles. Um, Coles has corrected a fair bit, and we'll look at that a little bit later in the presentation. But at 15.50, Coles is attractive, and I also think Woolworths at around this $40 level is worth buying. If you're holding a sizable position in them, think about selling covered calls, especially over Woolworths as a way of generating extra income. Beach at around that 150, 160, I think is attractive. I think it's still Woodside over Beach, but both of them deserve to be in portfolios. APA Group, we started to see a bit of a bounce in this from $9 back up to $9.50, and I think we continue to see a steady recovery in that over the next 6 months. REA Group struggle with the valuations there a little bit, but we have seen it switch from sell conditions back into buy at 110, and now we've had another buy signal here at this 130 level. A Lendlease, I like this as a longer term recovery. With the current earnings result was messy, which the market really expected that, but on a 12 to 24 month outlook we should start to see the fundamentals show through there and Lendlease perform better. I'll come back to the index right at the end. Fisher & Paykel, high PE ratio, but certainly above average earnings growth within the healthcare space. So if I'm going to be paying up for a high PE, I'm more comfortable in doing that within the healthcare space than in some of the technology or software plays. Fisher & Paykel, we like that at around that $26, $27 level, and we've been adding that in a portfolio. Suncorp Group support there at around $10. It switched from sell conditions back into buy conditions. ASX, so this looks to be getting down to oversold levels. We know the earnings growth is not terrific, but nearing just over a 3% dividend yield, and trading volumes, likely to be not as high as the last 12 months, but still at elevated levels. There's a point here where ASX gets oversold, crosses above the 10-day average, and you might want to have a look at that for portfolios. Star Entertainment, support there at around that 350 now under buy conditions. WiseTech, support there around that $27 level under buy conditions. Aristocrat, under algorithm buy conditions, supported around that $30 level. Sydney Airports, under buy conditions, but is at lower levels than where we entered the trade. From a trading standpoint, we bought it around this sort of 550, traded out of it around 650, back down to sort of $5, 550. We see that as support at the moment, and maybe the stock consolidates between that 6 to 650, but I don't think there's visibility on earnings for it to do too much in the short term. Transurban Group, within these infrastructure plays, within sort of the top 20, top 50, is one of our preferred allocations, so we like Transurban around that $12-13 mark. Domino Pizza's corrected from 120 down to 90. The last algorithm buy condition was back here at $70. It does trade on a high PE but a reasonable growth rate. I think there's better opportunities, but if we saw Domino's maybe back down around $80 on another leg lower in the US technology sector, then we might take another look at Domino's. Coles at around this 15.50. I think there's an argument you buy it and sell covered calls over it to drive extra income. Amcor, this offers value, so the company upgraded earnings to 10 to 14% earnings growth. Maybe it's been hurt by the higher Aussie dollar. The Aussie seems to have ran into resistance just under 80 cents and it's pulling back a little, but Amcor is a good business with growing earnings double digit, so expect that to find support or an inflection point there at $14 and trade higher. To me, fair value for Amcor's back up at around $15.50, $16. Link supported around that $4.80. Cube, fair value at the moment is around $3 for Cube, but has the potential to grow earnings double digits over the next 2 or 3 years. Soul Pattinson not doing there at the moment, but just highlighted switch from sell conditions to buy conditions there at that $26 level. Computershare now under buy conditions, and recent algorithm signal there at that $13 support. Sonic Healthcare, so this is an example we're pretty comfortable from a risk reward point of view. The bump in earnings in 21's partly been a result of increased revenues from COVID testing, but the underlying business still supports on a normalised operating basis about a 3.5% yield with the stock trading where it is at the moment. So I don't think you're too far away from Sonic finding support and trading a little higher. Alumina, support there at around 160, switch from sell conditions into buy conditions now. Qantas under buy conditions, support at 450. Appen Group downgraded earnings. Whether it can find support here at around this $16, we'll come back and visit that in more detail. Downer EDI delivered a great earnings result with a good outlook as well. Substantial, about 70% of the business is government contracted revenue, but the company's guiding towards double-digit earnings growth. So look for this as a buy on the dip opportunity in the correction from $6 back down to $5.15 where it is at the moment. Next DC, not really doing too much there at the moment. Newcrest continue to like the gold trade, although it's obviously been tough going over the last few months. We've predominantly seen gold trade within that band of $17.50 US an ounce to around $19.20, and it's consolidated within that for the last 4 months. As the Aussie dollar's pushed higher, the Australian gold producers have become less attractive, obviously less profitable converting US dollars to a higher Aussie dollar. Newcrest at around $24, it sits at the top of the list, but equally, Northern Star following the merger with Saracen looks attractive as well at sub $10. So our basket for the gold trade still remains Newcrest, Northern Star and Gold Roads, and then on the ETF side GDX and miners. So you make a note of those ETFs, but Newcrest continue. The production still looks okay, and we do think that during the risk off period gold rallies again. ALS now under buy conditions. A2 Milk continued with a further earnings downgrade, so we've now had 3. That old adage in the market, you buy on the third earnings downgrade, not always true, of course, but maybe that's the case with A2 Milk. It's really a matter of whether they can reposition the business and develop new distribution channels into China. But around 880, the stock price is down over 50%, and earnings are not quite down that much. Northern Star merge with Saracen, cost synergies to come through. We need gold to hold the $1,700 US an ounce level and push back up to sort of 1850, 1900, and we start to see better performance out of these. And at the same time, we don't want to see the Aussie dollar push too much higher. But keep a close eye on. They're a little bit out of favour at the moment, but a cross back above that 10-day average might act as a catalyst for you to think about adding them to your portfolio if you don't already hold them. Evolution we don't mind, albeit I've already gone through the priority or the preference order for the gold stocks. IDP has rallied from the algorithm buy condition there at 1370, now trading 26. Fortescue under buy conditions went ex-dividend today. Reese, so now we've switched into stocks that are under algorithm sell conditions, so I'll just move through these. So Magellan corrected really from 75, but of real interest is this recent high here at 65. We're now down at 45. I think maybe just keep that on your watch list, but we don't do too many counter trend trades, so meaning we're not buying too many stocks that are under algorithm sell signals, and the reason why that is for the most part the stocks that are under sell signals have a downtrending pattern of lower lows, lower highs, and I'll point out some that are breaking that and likely to switch back to buy conditions. Ramsay Healthcare delivered an okay earnings result, fairly flat, but the outlook statement was a little bit better than the market expected, but really at a 2% and a bit dividend yield, close to full value where it is. but an okay income contributor to portfolios. James Hardy, so here's an example of a stock that's broken up, made a new high. We'd be looking for this to pull back and create a higher low somewhere around this, say, $32 level, and a switch back to algorithm buy conditions, and we'd look to add that into portfolios. Mineral Resources, later this year, we'd expect to see that switch back to buy conditions. Santos still undersells, so our preference is Woodside and Beach. Tabcorp undersell conditions, not doing anything there. Nine Entertainment undersell, we'll look for that to switch to buy conditions later this year. Dexus undersell, again preference just buy the ETF SLF. Boral Limited, looking for that to switch to buy conditions later this year. Telstra undersell conditions at the moment. Not sure I fully agree with this. From a fundamental standpoint, Telstra has upgraded their 22-23 earnings outlook, and you've got the potential of the benefit from TowerCo being either sold or listed as a separate company. But a sale of Tower would lead to a return of capital to Telstra shareholders. Ansell, don't mind this business, and it is under sell conditions at the moment, but I think we'll see it switch back to buy in the coming months. But it is a little expensive, up at around $40 there, so for the moment we look at that as a stock that's likely to trade sideways. Centre Group, not doing anything there at the moment. NAB, look, our preference is on the long side of the banking stocks is really CBA and still the global banks ETF. And we're still a little bit cautious on some of the Aussie banks, especially in a risk-off environment, which is really sort of more predicated on a further correction in US equities, and at the best we're in the early stages of that developing. Macquarie Bank, so the market went from thinking that earnings would be down 20% to Macquarie only delivering a negative 8% result. So we're almost back to the highs where we started pre-COVID, and to support that, what we'd be looking for is at least Macquarie delivering somewhere between flat to 5 to 10% earnings growth over the next 12 months. So we'll continue to look at the next half results there in Macquarie. Origin, not doing there, but within some of these beaten down stocks, I think there's value for Origin because of the Australia Pacific LNG project. Spark Infrastructure, not doing there at the moment. BHP, continue to like this, and we think sort of BHP, Rio, Fortescue. If you're sitting on good gains there and you want to trim some of it, that makes sense as just taking some risk off the table. Oil Search, preference Woodside and Beach over Oil Search. Brambles, so this is one that we like from a fundamental standpoint. It has been hurt a little by the strong Aussie dollar, but the company upgraded its earnings from around 3 to 4% earnings growth, or 3 to 5% earnings growth, to 5 to 7% earnings growth. So that's got to be a good sign, and I guess evidence of management's confidence in the business over the next 12 months. So at around $10, we think Brambles offers good value as a counter trend trade. ANZ, we look for generally for the Aussie banks to have a leg lower and then a switch to buy conditions later in the year. So that includes Westpac as well. Crown, roughly up against resistance at around $10. Medibank, good yield play, but not too much inspiring on the earnings side there. Bank of Queensland, not doing there at the moment. Bendigo had a sharp after a result that was better than market expectations. We've seen it correct from around $12 back down to sub $10. Treasury, not doing there at the moment, but keeping an eye on the turnaround story there. Orica, we've seen earnings downgrade and the CEO step away there. But the argument for Orica is the other issue for Orica was obviously the ban on thermal coal exports from Australia, which impacts some of the clientele that Orica provide explosives and mining services to. But in general, the outlook for the Australian mining sector is quite robust. So a slight repositioning and pivoting by Orica, we'd look at that as a potential recovery opportunity in the market from a fairly low valuation standpoint. So we'll continue to monitor Orica. Ampol, really trading range between $23 $23 and $30. The refinery business obviously took a big hit to earnings given jet fuel and in general the amount of traffic on the road, lower levels, lower demand, which has flowed through to lower earnings for Ampol. Is that 23 level of support? Maybe, but I'd like to see sort of more evidence of a return to earnings growth there in Ampol, so it's undersell conditions at the moment. AGL undersell conditions, so lower lows, lower highs. Fair bit of bad news priced into AGL at the moment. South 32, really preferences BHP, Fortescue, Rio over South 32. Rio breaking up to new highs. We'll likely see that switch to buy conditions, but I've been an advocate of really holding BHP, Rio, Fortescue. Challenger, not doing there at the moment, under sell conditions. Coca-Cola, obviously got the takeover bid from the European Coca-Cola entity. Incitec Pivot, we've really sort of played that as a rebound from that lower levels there back to fair value, but we'll wait for that to switch to buy conditions. QBE under sell conditions, but delivered a better earnings outlook than a number of analysts had anticipated. Insurance Australia Group, I think this is a potential oversold recovery story for the Australian market over the next 12 months. Worley's not doing there at the moment. Horizon under sell conditions, so we've seen sort of this cascading lower lows, lower highs. Sell signal there at 5, another one there at around $4. Stock now trading $3.77. Obviously exposed to freight moving within that coal space, especially in Queensland. IGO Limited, not doing anything there under sell conditions. Oz Minerals, copper's had a very good rally, but there's a number of analysts that are talking about the added supply that's starting to come onto the market from South America, and will go from sort of a deficit into a surplus supply of copper. But certainly copper's had a fabulous run over the last 6 months. Any correction that we see in copper prices obviously will result in Oz Minerals trading lower, and that could result in a shift from sell conditions back into algorithm buy conditions at lower levels there on Oz Minerals. AMP not doing there at the moment, and there we are back to TPG. So I'll just finish tonight with a couple of things. Let's just have a quick look at these ETFs that have made it onto the list, and for a more detailed look at the ETFs, maybe go into the model portfolio and have a look at either the iShares portfolio or the all ASX ETFs. So they're looking at either all the ETFs that are by BlackRock iShares, and that model's performing very well, or this one covers all ASX listed ETFs. I was just going to bring up a chart of a couple just to have a look at. So the SLF Spider Property Fund. So rather than buy, I think Goodman Group's a bit of an exception because of its high earnings growth. But maybe rather than buying too many of the individual REITs, you could have a think about a basket trade approach through this SLF, which just gives you broad longer term exposure to recovery in the listed property sector in Australia. Other ETFs to have a look at is Cure. We've made money on this in the past. We've taken profit on it. We've now seen it correct from 85 back down to $70. The last algorithm buy signal was back there at around 60, but keep an eye on that. CNU, which is the two ways of playing, either the IZZ, which is the index exposure to the Chinese stock market, or the CNU. But to me, this looks like it's finding support after correcting from 10 down to $8.50 or $8.25. It is under algorithm buy conditions. We've got the stochastic moving higher, and the setup there looks interesting for CNU. GDX being a fairly tricky, the downtrend in this gold space, so from thinking that we're looking at support there around 45, it's now traded back down to 41. But again, if you sort of felt that you want to have sort of a risk off element to your portfolio, then obviously gold exposure is one way of doing that. So GDX. From a growth standpoint, if you're wanting to play a continuation of the current growth trend, the IKO, which is the iShares South Korea, so this has just been added into our iShares model portfolio at around that 112 level. So have a think about that from a growth standpoint. And just to finish with the Xjo Index, so we've had the strong rebound today, and the Nasdaq in pre-market trading in the US would suggest that the Nasdaq's going to have a similar attempt at sort of retesting this 10-day average. The sell-off in the Nasdaq's a little deeper than what we've seen in the XJO, which just reflects the that selling of that growth theme or the high PE stocks in the market. But so we remain a bit cautious as to the impact that a continued rotation out of growth into value, and how much value is there really in the value names. So we look to build portfolios with those names that I highlighted tonight. There are a couple of growth stocks that make their way in there with car sales and Zero. There's Fisher Paykel. But for the most part, we're more attracted to Brambles, Amcor, CSL, Sonic Healthcare, those names that I covered. So if you want to discuss in more detail the names that we think belong in portfolios at the moment, or inquire about opening a broking account with Investor Signals and participating in one of our models, then again give me a call on 1300 614 002, and I look forward to speaking with you again next week. In next week's recording, rather than toggle through the top 100, we might focus on some of the individual lists just as a bit of variety for